Hi guys, this is day 15 of the A2 Economics Revision Challenge, and today we are doing three concepts. One is the downward sloping AD, why is AD curve downward sloping and its relationship with interest rates. The second concept is of the price of bonds, why there is an inverse relationship between interest rates and price of bonds. And the last concept is liquidity trap. The first concept we'll discuss is the downward slope of AD and interest rate. We say AD curve is downward sloping is also because of the fact that we identified called interest rate effect. The interest rate effect simply says this, that when there is an increase in price level, there will be an increase in the demand for money, which can result in interest rate to rise, and therefore consumption and investment to fall, which can result in national income to fall. So I'm going to explain this concept, the idea that how an increase in price level can make the demand for money to rise, and that demand for money, if it goes up, how does that affect interest rate and therefore consumption and investment to fall. So let's start off with the first diagram, which is the AD curve. So let's say price level of an economy goes up from P0 to P1. So let's call that P0 to P1 is step number one. So when the price level of an economy goes up, suddenly people will realize that in order to undertake the same amount of transactions, they do not have the money to undertake the transactions. So here on the other diagram, I'm going to make my LP naught, or demand for money. Let's say currently we are at LP naught, and currently money supply is MS naught, and our interest rate is R naught. Okay, let's say when the price level goes up, people realize that because of rising prices, they can't they can't buy the same amount of goods and services with the money they have. They started demanding more money. When they start demanding more money, liquid demand for money goes from LP0 to LP1. So this is my LP1, and that causes interest rate to go up. So we say a rise in price level can cause basically interest rate to go up, and that rise in interest rate, let's call this number 2, which causes number 3 is interest rate to go up. With this rise in interest rate causes basically cost of borrowing to go up, incentive to save to go up, and therefore people will realize that consumption will fall and investment will fall. Why? Because the cost of borrowing is going up, incentive to save for people is also going up, and that results in ultimately your GDP to fall, which is number 4 step, which is what I'm going to say. Number 4, GDP will go down. So this is kind of like explaining why AD curve is downward sloping. When the price level goes up, it causes the demand for money to go up, and that puts the pressure on interest rate. This rising interest rate results in consumption to fall and investment to fall, and therefore GDP of the economy to fall. This brings us to the next concept, which is called interest rates and the price of bonds. We also say this, that the interest rate has an inverse relationship with the price of bonds, and the reason why is that is what I want to explain in this video. But before I talk about that, we notice that when a government is issuing a security or a government bond, that bond has a fixed dividend rate. For example, let's say there's a 10% dividend rate and a face value. Let's say it's a $100 bond, and then there will be a tenor, let's say for example 10 years. So if there is a fixed dividend rate, this means every year you will get, for example, if you buy a $100 bond, you will get 10%, which is $10 every year for the next 10 years, and at the end of the 10 years you will get yourself your principal back. So it's just like any other debt, but the difference between a normal debt and this debt is that there's a market, a secondary market, where you can at any point in time sell your bond. So that market where you sell your bond in between, let's say third year I've bought a bond, and in the third year I say, you know what, I want to sell this bond today, then there will be a market price or the price of the bond, which actually has a strong relationship with the interest rate. So we say that interest rates determines the price of bonds in that secondary market, because the primary market might have a price of $100 where the government sold this bond to any individual, but there's a secondary market where this bond is sold, which is actually dependent on interest rates. So let's talk about that. Let's say, for example, currently the interest rate is 15%. So let me write this. Let's say currently interest rate is 15%. Okay, R is for interest rate. Let's say it's 15%. And let's say you have a bond which has a dividend rate or rate of return. Let's call it rate of return of, and let's call it short form RR, rate of return of, for example, 5%. Now, when the banks are offering you 15% interest rate and there are bonds which has a lower rate of return 5%, people will not be demanding this bond. So when we say that when the interest rates are high, the demand for bonds which are giving lower return will be low. And when the demand for bonds will be low, we say this, that the price of bonds will be low. And if the price of bonds are low, guys, what will be the stance of a speculator? Well, a speculator is somebody who we know is the one who sort of buys lows and sells high, because he's holding money for speculative purposes. Now, when the interest rates are when the price of bonds are low, this is where we know speculator will be, basically in this case, let me write this, speculator will buy bonds. So when everyone else is selling because the price of bonds is going down, the speculator on the other hand will be buying bonds. But the first concept to understand is that high interest rate means low price of bonds, and low price of bonds means speculator will buy bonds. And if speculator buy bonds, we know this, that he will be holding less money balances. Why? Because he is holding more bonds and therefore less money balances. Similarly, when the interest rates are low, let's talk about that concept. When the interest rates are low, so let's say interest rates are low. Let's say interest rates are, for example, 2%, right? And let's say your bond is still giving you 5% return. Then we can say that demand for bonds will be high. Why will they be high? Because when the interest rates are low, people will be like, you know what, the bonds are giving us better return, let's buy them. So that's where the price of bonds will be high, because people will be demanding them. And that is exactly the point. We will have our speculator who will realize this as an opportunity, and he will be like, you know what, let's sell, because speculator is always selling when the price is high. So speculator will sell bonds, and that results in him, when he sell bonds, to holding more money balances. So the idea goes this, that speculator at that point will be holding more money balances. So just to recap, when interest rates are high, the price of bonds are low, a speculator will be buying bonds and holding less money balances. Similarly, when interest rates are low, the price of bonds are high, and speculator will be selling bonds. This can be seen through a diagram as well. So let's see the diagram now. When your interest rates are high, so let's call this R high, we know this, that we will be holding less money balances. Let's say Q naught. If I'm a speculator, I'm holding less money balances. Why? Because when the interest rates are high, the price of bonds are low. And when the price of bonds are low, this is the point the speculator will buy bonds. And when he's buying bonds, he doesn't need to hold money anymore because he's already bought bonds. Similarly, when the interest rates are low, let's say are low, that's when he will be holding more money balances, because that's the point when the interest rates are low, the price of bonds are really high, and that is where he will be selling bonds. And this explains why we have a downward sloping, very interest elastic speculative demand for money. Speculative demand. So, according to the speculative demand, high interest rate means low money balances, because speculators buying bonds. Low interest rate means high money balances, because the speculator is selling bonds. Now we'll use this concept to talk about liquidity preference curve, which uses the concept of your price of bonds and interest rates. According to liquidity trap theory, which is Keynesian's concept, they believe that the speculative demand for money is very responsive to change in interest rates. So, let's say if people believe that the rate of interest will rise in the future, how will people react? If the rate of interest will rise in the future, or they expect the rate of interest to rise, they notice the price of bonds will fall. Why? Because it has an inverse relationship. So if the rate of interest is rising or about to rise, the price of interest will fall, and if the price of bonds will fall, and if the price of bonds will fall, few people will want to buy them. And if few people want to buy them, then they notice that at that point, when people believe that the price of bonds will fall in the future, they will want to buy them later rather than right now. What will they do instead? Well, instead, they will be holding a lot of liquid assets like money and near money, with the hope that when the interest rate goes down, they will basically be buying those sort of government securities and bonds. So, if the expectation of a future fall in prices means that you will buy bonds later. So when the interest rates are when the interest rates are expected to rise, the price of bonds is expected to fall, and when the price of bonds is expected to fall, people will hold more money balances, and therefore one could argue this that the demand for money will be responsive in this case. Now, Keynesians also build this argument. They say that the demand for money is very elastic, therefore, to change in interest rate. In fact, they say this, that the demand for money or liquidity preference curve will be extremely shallow or flat at very low interest rates. So they draw a diagram which is something like this, where when they draw the liquidity preference curve, they draw a liquidity preference curve which is which is downward sloping but become very flat at low interest rate, like something like this. And they say that if the interest rates are, like for example R naught, let's say if the interest rates are really low and people expect interest rate to not fall any further, this means price of bonds are really high. So let me write this: R is low means price of bonds is high, and if the price of bonds is really high, nobody is going to buy bonds, because people expect only to bonds to fall, and they don't want to have any capital losses, and that basically means people will basically hold liquid assets. So liquidity will be very high at that point in time. So let's show this in terms of a diagram. So let's say right now my money supply is, for example, ms, right? And let's say money supply goes up to ms dash. What is happening is this, that when the money supply went up, interest rate did not change. Why did it not change? Because we are in a very flat zone of liquidity preference curve. When the money supply goes up, interest rate was so low and price of bonds were so high that people did not buy any bonds. In fact, any rise in money supply, people just held those extra money that was basically given by the government. So this is the point where people just believe that the interest rates will only rise and price of bonds will only fall. And if the price of bonds will only fall, the the market for bonds or the market for any goods may not sort of happen, because people's strong belief that prices will fall in the future will dictate them to hold money rather than buy goods and services. So with a very shallow, you can see this with a very shallow demand curve, a very elastic kind of a demand curve. When your money supply goes up, the interest rates is not going down, and in fact, if there is a change, there will be a very small change of interest rates. So once people believe that the rate of interest will not go any further rise in money supply will have no effect of interest rates, and this is what we call liquidity trap, where people will simply hold idle money balances. So the idea behind liquidity trap is this, that there is a possible recession that can happen when the interest rates are really low. Why? Because people are not going to spend any thing on goods and services because they expect the prices to fall. If you remember our discussion from deflation, we talked about the idea that in deflation there is a general concept that the prices are falling and they will fall further, and therefore people do not spend too much money. So that's exactly what Keynesian's argument is that when the interest rates are really low, the economy is in a recession where people do not want to buy goods and services because people are expecting the prices to fall further.